Happy New Year and a warm welcome to All About Money on HKIBC. I'm Chloe Fong. Will the year of the rabbit be a turnaround year for China? While the world's second largest economy is expected to rebound this year by moving on from COVID-0, authorities still have to deal with domestic problems such as weak consumption, a real estate market downturn, and even a population decline. So how will Beijing navigate through these challenges? Joining us today is Aidan Yao, Senior Emerging Asia Economist at AXA Investment Managers, who will share his views on China's outlook. So welcome to the show, Aidan, and it's great to have you today.
Thank you very much for having me.
Previously, I read one of your recent articles published on S&P, and you said that China's economy is now living its darkest hours before the dawn. So I'm thinking at the beginning, how would you assess where we are now amid this kind of darkness toward the road to recovery?
Well, I think the journey towards recovery has already begun. Clearly, if you look at the official data, it still paints a very bleak picture, but that's very much backward-looking. If you look at the forward-looking indicators, high-frequency data, on mobility, on traffic congestion, on freight volumes, on daily house sales for top 30 cities, you see a consistent pattern, which suggests that the economy bottomed in the middle of December and the recovery has taken hold over the last couple of weeks. We have seen this recovery accelerating so far in January as well. Now, clearly, this improvement has been led by cities that have already passed the peak of infections. But as other regions and the cities follow suit, one should expect the momentum of the recovery to gain further steam. So I think the journey towards that recovery has already begun.
And also, because the authorities also released is 2022 full-year GDP growth data, and with a pretty weak performance, we can say, you think that we're now bottoming up now, right?
Exactly. I mean, as I mentioned, those data are very backward-looking. They show a pretty bleak picture, which should be expected because they capture a month and a quarter during which China was really being hit pretty hard by this exit wave. Now, for investors and financial market, because we are forward-looking, as the economy is turning around the corner, the data that captures the economy before that turning point now become less valuable. So I think investors should really pay more attention to those high-frequency, forward-looking indicator on mobility, on freight volume, on house sales that I just mentioned to gauge what really lies ahead for the economy going forward. And I think the turnaround of those indicators do provide some confidence for the market that what China is facing right now is very much a transient shock, and there's a recovery lying beyond the near-term struggles.
So last year, the fourth quarter GDP growth was down to 2.9%. It brings the full year GDP growth to 3%, missing the target of 5.5% set by authorities earlier. How would you comment the overall data performance, and what were the specific indicators that have caught your attention?
Well, the performance has been very poor, but still beats market expectations because market expectations were very, very depressed, knowing that December and fourth quarter in total was really a period that China's economy struggled against this exit wave. So even though that in absolute terms, the situation was pretty bleak, it was still actually better than expected. Now, what really caught my eyes were really the retail sales numbers as well as the services activity. They caught my eyes because they actually show a bit of a sequential improvement relative to November. So this is December relative to November, which seems to be somewhat counterintuitive given the third-party data and the perception that China was really being hit by the surging COVID cases. Now, it's entirely possible that I think the December months might be capturing some of those improvements in the second half of December when certain cities and regions exit from the peak of COVID infections. And if that's the case, then that suggests that maybe the turning point has also occurred slightly earlier than expected, and one should expect sequential growth to improve further in January.
All right, but now, we're still facing maybe the peak half past in some top tier cities. We still have the concerns, amid the Lunar New Year Spring Festival, when so many people are returning to their hometowns, it might bring another wave of infections at the rural areas. So, I mean, how long do you think this whole nationwide infections could peak later on before we can really see the momentum being picked up?
I think it's very difficult to say because we don't really have a real-time estimate of the extent of infections. Remember that the Chinese authorities have stopped releasing the daily data on cases and deaths since December. So we are essentially flying blind, to be honest. But even without the case numbers, I think what we can gauge is the mobilities, it's the traffic congestions, it's the free volumes, it's the number of people on metro subways, and so on and so forth. So as I mentioned, insofar as the cities are concerned, we have already seen these activities bottom in the middle of December. So we are already seeing green shoots and the lights at the end of the tunnel. Now, clearly you point out that we are not completely out of the woods just yet, because we are counting down to Lunar New Year. We are in the midst of biggest human migration on Earth. And this mass traveling is going to accelerate the transmission of a virus from cities to rural regions, where the medical infrastructure is less well equipped. People are of older age and tend to be less medically ready. So I do think that there's a near-term risk that we need to monitor very carefully, and to what extent this social shock or public health shock could morph into an economic shock, particularly if migrant workers delay their returning back to the city after the Spring Festival because they have to look after the sick. So that's something investors need to watch very carefully.
And also, I want to point it out because in your article, you also said that the much needed reopening came also at a pretty stressful social cost, as the public health system was under significant pressure, as you just mentioned. What is your view about the overall reopening from China? And do you think Beijing authorities could have done better prior to the reopening?
Well, I think it is always improvement with any government policies. If we compare what has transpired over the past 2 months to our prior assumption about the reopening before the policy pivot, we assumed a gradual three-step reopening. Step one is shoring up China's medical defense by increasing vaccination, building up antiviral drug, and constructing few hospitals and ICU capacities. This then lead to step two, allowing China to open up the domestic economy and society. And then step three is about relaxing the border controls, reintegrating China with the rest of the world. Now compare that assumption to what happened over the past 2 months. Effectively, step one was completely skipped. There was no significant preparation mentally and medically to speak of. And step 2 and 3 have been significantly fast-tracked as well. So essentially by January the 8th, China was fully reopened to the rest of the world. Now, had China adopt a more gradual, cautious approach as per our assumption, I think we would have lower stress on the public health system and maybe less shock to the society. However, that means that China will have to endure a prolonged period of economic struggle because this gradual recovery is probably going to take another 6 to 9 months. So the economic shock will be more prolonged. And you can see that there's really a trade-off between the economic result and the social result. So I don't think Beijing had a superior option on all fronts. Maybe the superior option was to start reopening after the Shanghai lockdown. But given that reopening was postponed to November last year, I don't think we had a superior option. We had two inferior options, and that means that something had to give.
And also, speaking of COVID, do you think it will also leave some permanent change for the country's economy as well? What will be the changes, notable changes from your point of view?
So this is effectively a question about China's potential growth and whether China's potential growth has been harmed by 3 years of the pandemic. Now, clearly, as the economist, I can tell you that estimating potential growth exposed of a certain shock, it's hard enough. Let alone measuring it to real time when this shock is still playing out. Now, that being said, I think it's very difficult to think that the 3 years of rolling disruptions will have done very little or zero damage on China's potential growth. In the report, I mentioned that anecdotal evidence of foreign firms relocating their supply chains out of China, closure of small, medium-sized firms, and the reduction of quantity and quality of education. All of these things should contribute to some reduction of China's potential growth. Now, I suspect that one way we will be able to tell whether these damages have indeed occurred is by monitoring the economic recovery over the course of 2023. If there have been permanent damages, then two things would happen. One is that Chinese economy will struggle to go back to pre-pandemic growth rate. And two, if Beijing tries to hit that rate with a significant policy stimulus, then inflation will rise, very much like what we saw in US and Europe last year. So I suspect that even though it's difficult to tell right now, but by monitoring the economic development over the next 12 months, we may get some telltale sign on what happened to China's potential growth.
Right. Thank you very much for your thoughts, Aidan. We'll take a short break for now, but coming up next, we'll have more discussions over China's economic outlook in the year of rabbit. So do stay tuned. Welcome back to All About Money on HKIBC. I'm Chloe Feng. Joining us today is Aidan Yao, Senior Emerging Asia Economist at AXA Investment Managers. We're talking about China's economic recovery outlook for 2023. So welcome to the show, Aidan, and thank you for taking the interview with us.
It's great to be here. Thank you.
And earlier, we have briefly reviewed about the 2022 economic performance in China earlier. On the production front, we have seen a growing number of foreign factories being relocated to other Southeast Asia countries, for example, in India, Vietnam. This is a very concerning trend and is still happening. Do you think this trend will continue or reverse after China reopens its border now?
So I think one thing we need to be mindful is that part of this trend is inevitable, because when the economy is maturing, the available pool of cheap labor shrinks. Land costs also tend to rise. Beijing in recent years has also focused on cleaning up the environment, so cost of pollution has also risen as well. So you have rising land costs, rising labor costs, rising environmental costs. And if you are a foreign firm operating in China, facing pretty thin profit margins, on the back of these rising costs, it becomes unviable to continue to operate in China. And therefore, certain firms relocated their supply chains to countries with much cheaper cost of production is entirely understandable. However, I would say that this paradigm shift has been accelerated in recent years because of geopolitical development, because of trade tensions, technology tensions, and of course, as you mentioned, the pandemic over the past 3 years. So I think for Beijing, as you mentioned, this is a disconcerting trend. What can we do actually to reverse it, or at least protect the existing supply chains in China? I think Beijing needs to do two things. In the near term, the dismantlement of this zero-COVID policy is absolutely critical, because it allows the resumption of flow of people, flow of investment, and flow for businesses. It will significantly restore foreign businesses' confidence in the Chinese economy. Over the medium term, I think the onus is really on Beijing to continue to open up its economy and financial market, to try to repair relationship with other countries who still are willing to work with China, tell a more genuine and better China story to dispel a lot of misunderstandings. And locally, I think it's important to show up the rule of law, making sure that the interest and the rights of foreign firms are well protected, and there's a level playing field for Chinese firms and foreign firms. If Beijing can hit all these notes, then I think China's competitiveness can be well protected, and the supply chains can be kept within the country.
Interesting points, Aidan. And also, because previously many foreign firms, the reasons why they left China is not only because of COVID, but also probably because some moves by Beijing authorities, for example, the crackdown on the tech industry, on the tutoring industry, and also many investors were concerning that Beijing authorities were focusing on ideology instead of growth. But now that China is reopening up, so do you think there would be a chance that those investments will come back once Beijing authorities kick all of those points that you just mentioned?
I think capital is already coming back. Look at the equity markets. We have rallied, Hang Seng has rallied 50% from the lows. Right. And that suggests that the capital is rethinking about the China story. We have seen RMB appreciation. We have seen credit spread narrowing. All of these suggest that the capital is coming back to China. Now, clearly, the pivot to the zero COVID policy has been very instrumental. But on the regulatory front, on the housing market front, we have also seen policy turning the corner as well, particularly for the tech sector. We have seen the data investigation for Didi, it's almost coming to an end. We have seen reports suggesting that Ant Financial is getting a second chance to do IPOs. We have seen new games being approved. In fact, 3 batches of games being approved after the party congress. All of these suggest that not only we have seen a holding of that regulatory crackdown that started in the first quarter of 2021, we are now actually seeing signs that the regulatory headwinds are now turned into regulatory tailwinds. So I think all of these, in conjunction with the economic recovery, are going to be very instrumental in repairing the investor confidence in China.
And also, another very concerning issue, the authorities disclosed that the population plummeted by 850,000 to 1.4118 billion last year as deaths outnumbered births. I mean, but we earlier just briefly talked about how China is transitioning to a more advanced economy. Do you think, this aging population or these demographic changes would happen anyway as we transition to a more developed economy?
Yes, it would have happened anyway. It's just that it happens a lot earlier than market had anticipated. I think prior to the data, prior to the pandemic, most people thought that the turning point of China's demographic cycle would occur at the end of this decade. And obviously, in the last 2-3 years, given the sort of disappointing population numbers, people thought that it will occur in the middle of a decade. And I think early this week, the data was quite a big shock. It suggests that it's not in the future. It was actually already occurred last year. So I think this demographic turning point has been front-loaded quite significantly, and that is a bit of a concern. It is not a concern for the near-term economic recovery for 2023, because it doesn't really move the needle insofar as what's going to drive this recovery this year. But it is a concern for the medium term, because we know that population growth is a critical component of a country's potential growth, because it gives you the availability of labor for that economy. Many people attribute Japan's lost decades to the very rapid turn of its demographic cycle. And for China, we are seeing this turning of the cycle occurring at a time when China is at a lower level of development compared to Japan. So I think that's really a cause for concern for Beijing. They need to take actions. There are no silver bullets, but certainly there are certain things that Beijing can do to slow the deterioration of the demographic decline.
Right. And also we've seen the labor population have been dropping and aging population increases, and that means it also puts pressure on our pension system as well. And you mentioned about the Beijing authority needs to take action. What kind of actions can be adopted to tackle this issue, this much earlier than expected population crisis, if we may say so?
So I think three things could happen in the near term. Well, not in the near term, but on the sort of a growth side. China's birth rate has fallen quite persistently over the past decades, and clearly the birth rate has got to a level that is very concerning for the economy. So there has to be some incentives for households to develop a bigger family. We have seen other countries giving subsidies, even giving cash handouts for families having more than one children. Some of these policies are already being implemented at certain local government levels, so that will help. Secondly, I think it's the extension of the retirement age. China's retirement age is actually very, very young. I think for male it's something around 60 years, and for women it's around 55. They are lower than developed country levels. So if you can postpone the retirement, allowing people to stay in the labor force for a couple of more years, I would imagine that they will have will help to delay the declines of the labor supply. And finally, technology can help. Automation, robotic, AI, all of these things are replacing human in the workforce. Right. So China is obviously the leader in many of these fields, and I think argue for further resources to be put into the development of these industries.
And also speaking of the labor market, we've seen also a lot of pressure on the labor market as well. A lot of youth, nearly 1 in 5 teenagers in China is facing unemployment. Do you think now the labor market will also improve in China after the borders are reopened now?
Absolutely. I think if you think about this pandemic and zero COVID policy, it really dealt a shock to both the supply and demand of the labor market. It hurt the demand because of a slowing economic growth. It hurt the supply because of the restrictions the policy placed on mobility. And that particularly hurts migrant workers because they cannot move around so easily. So now with the reopening taking place, all these COVID restrictions are being removed permanently. Mobility situation should improve, people can move around, labor participation should increase. You should also see the recovery of the economy increasing labor demand as well. So I certainly think that this reopening is going to help to alleviate the pressure in the labor market.
And one last question, Aidan. What should we be concerned most about now? And what do you think we can expect in terms of the policy, supportive or stimulus policies next?
So in terms of risks, I'll say that in the near term, we still need to watch the COVID situation, particularly how it plays out in the rural sector. Over the course of 2023, I'll say a more pertinent risk is whether consumption is going to recover. This is a critical assumption underpinning this recovery story for the general economy. And there could be reasons for why consumption doesn't pick up as strongly. If the labor market doesn't recover as fast, if we have an overestimation of the pent-up demand, and if there's a permanent damage that leads to impairment in household balance sheet, then consumption may disappoint. So those are the risks that we need to be mindful of. In terms of policies, we don't actually expect too much more additional stimulus to come through, simply because I think enough stimulus has already been pumped into the economy. And now with the economic reopening and cyclical upswing in the property market and change of regulations, we think that the stimulus that was already in the system last year could find their way into the real economy. So even without further additional policy easing, I think that improvement of policy transmission is going to help to do more heavy lifting for the economy and to support economic growth.
Thank you very much for your thoughts, Aidan Yao. That's Aidan Yao, Senior Emerging Asia Economist at AXA Investment Managers. And thank you for watching All About Money. We'll be back on HKIBC next Sunday night. Until the next time, please take care and 恭喜发财.